Hi, glad to see you this wonderful day. I am Professor Ramkrishna and welcome to my YouTube channel Archiversity. Through this YouTube channel, I share my knowledge in finance, accounting and other management subjects with students like you across the world. So in this lecture, I am going to explain the topic of accounting process, or we can say that in simple terms, we can say it as an accounting cycle. So the accounting cycle is directly derived from the accounting definition. In one of my lectures, I explained detailedly about accounting definition. So if you didn't watch that video, before watching this, I suggest you to watch the video on accounting definition so that explanation in this lecture will be more meaningful and easy to understand for you. Okay, now we proceed with our lecture on accounting cycle. This accounting cycle is directly extracted from the accounting definition, where in accounting definition, first we pay our attention towards analyzing of a business transactions. In the sense, to make an entry into books of records or accounting, we have to check its financial character. In the sense, whether this particular transaction is of a financial characteristic or not. In the sense, suppose if you deposit money in a bank, so this has a financial character because money is involved and you are making a deposit into a bank. So this is a financial character. Suppose you are paying a salary to your employees. So this is also involved in some money is involved in this, and which is a financial character we consider. Suppose if a manager appreciates his employee by saying good, well done or a good job done and all. So this doesn't involve any financial character and is not recognized as a transaction in terms of accounting. Similarly, an employee in a company performs a research and identifies or invents a product. But unless this invention, in the sense, is useful, or you invested money on that invention, it is not considered as a financial character. So to recording a transaction in accounting, we have to see that whether the transaction is financial in nature or not. Then next is that make a journal entries. So making a journal entry is your recording. In the sense, all the transactions and events which are of economic in nature, that is which are of a financial character, and so these financial characters, that is your transactions and events, what is that we do is we will convert all these in terms of a money and then record in our books of records. So this is what we call as a recording. So in recording, we do we record all the transactions and events measured in terms of a money and in a chronological order. In the sense, when we say that chronological order, as and when they occur, those are recorded here. And another important aspect of accounting definition is classification. So here the classification is done in a books of called as a ledgers. So here classification. So recording is done in a book called as a journal, right? We call this as a journal or journal entries. Then classification is done in book called as a ledger. So classifications are done in the sense we classify each transaction according to their nature. Let us say we create one ledger for rent, we create one ledger for cash, we create one ledger for sales, that is a credit sales, we create another. So according classification we do, and we enter them into a ledger. So first we identify transactions, then we record them in a journal books, then we post them into a ledger. So from journal to ledger, we call this process as a posting. In journal, it is a recording, and from journal to ledger is called as a posting. So once we create our ledgers by classification and all, then the another step in our accounting definition is summarization. So summarization is done in a statement called as a trial balance. So here what is it we are doing is we are creating a trial balance, in the sense in a trial balance we simply record all the summarization for a particular time period. Maybe total sales during a year is recorded here, total purchases during a year is recorded here, then total rent paid during a particular year or for a time period is recorded here. So we create a summarization and we try to see a balancing, in the sense when we are talking about a trial balance. So here we try to balance between our expenses with our revenues. So we are just simply we try to see that whether it matches or not. Now after creating a trial balance, after summarization, there are some entries which we miss, in the sense this maybe, let us say you have a closing stock, in the sense at the end of the financial year the stock is not accounted on the exactly on the day when we close the accounts. So closing stock is assessed or measured next day. Similarly, there may be some transactions from where we have not received money, or where we have to pay, we paid some advance. So we'll make all those adjusting entries here after preparation of a trial balance. Then based on this, we will prepare a adjusted trial balance. So in case of adjusted trial balance, you have a trial balance plus adjusting entries are considered here. Then we prepare various financial statements. So our financial statements include income statement, or also called as a profit and loss statement. Then you have a balance sheet. Then we have a cash flow statement. So these are different financial statements we prepare based on the information that we receive from adjusted trial balance. In the sense, adjusted trial balance will help us to prepare these different financial statements. So once these financial statements are prepared, then what is it we do is we prepare or we close our accounts for the particular time period. In the sense, when we are saying that a close of accounts, so suppose your income statement is there, now company made a profit. So assuming that if a company made a profit, this profit belongs to the equity holders or the owners of the company. So your income statement is a temporary account and your balance sheet is a permanent account. So in a close accounts, what is that we do is we make an adjustment entries transferring accounts from temporary accounts to the permanent accounts. So where we make adjustments for our profit, then if any dividends are paid, dividends, then closing stock is there. So once we have a closing stock for this year, this is considered to be an opening stock for the next year. Likewise, any transactions that we have to move from temporary account to permanent account is recorded in a close of accounts. Then finally, we prepare a post-close trial balance. And after preparation of post-close trial balance, this financial year or accounting year ends, then the process again commences with the step 1, that is identification. So this is a vicious circle. So every year we go through with these different stages, starting from your analysis of a business transactions to post-closing of a trial balance. So and each and every step we can say that we have a journal entries, then ledger, then preparation of a trial balance, then adjusted trial balance, preparation of financial statements like income statement, profit and loss, balance sheet, then closing entries, moving from temporary accounts to the permanent accounts, then post-closing trial balance. Again, new financial year begins with the analyzing of financial transactions. So these are the this is about accounting process or accounting cycle. Now you can now easily make out that the relationship between accounting definition and accounting cycle. So whatever it is mentioned in accounting definition, exactly the accounting cycle is prepared in those lines. Thank you for watching the lecture. See you in the next lecture with different topic in Introduction to Financial Accounting. Thank you very much.